Ladies and gentlemen. My name is Marcus Gonçalves. I first of all apologize for not being here with you today. Some incident happened and of personal nature, and I couldn't be here. I apologize, but I would like to share with you a little bit my thoughts on impact investing. I thank Social Impact and Deloitte for inviting me, and again, I apologize for not being here in person. Maybe we could see each other Thursday in Macau at the University of St. Joseph. Diving right into our talk of the day here, what is impact investing? There's a lot of discussion out there in the world, on the West and right here in the East. There are books written about it, lots of articles, lots of information, but it seems that there is not a good understanding on how social investment and business are making a difference in the world. This is particularly so when we consider the millennial investors. They want to invest with value. They want to invest with their own moral values. They want to make a difference in the world. So what is impact investing? That's the main topic of our short talk today. I would like also to take a look at how it works. There's a lot of misunderstanding out there. And if we have some time, some case studies, I brought a short video for you. The idea of social investing has been growing tremendously. What is it? It depends who you ask. But bottom line, as you can see in this graph, social works from the point of view of philanthropy. As you look at the lower quadrant here, there is no return. You invest because you want to impact society, you want to do some great good for society. The impact tends to be very high, but the focus is not on return. This is not impact investing. But by the same token, on the other side of the spectrum, a typical investor, a traditional investor, is not so concerned about impacting society, communities, making a difference. The objective here is return on investment. So very low impact, but high returns. What we are looking at, the impact investing zone, if we may, is to still provide high impact, but is still provide enough investment with enough return. So the idea is, at least in my experience consulting out there in frontier markets, companies like the sovereign Norwegian company agency, if you may, Norfund, which is very known in this area, it's a return on investment that is low compared to traditional investors, but the mark, the legacy, the impact in the community is immense. So definitions out there vary, but we tend to refer, when we talk about the impact investments, is the kind of investment that we do with companies, organizations, funds, but the intention is to generate a measurable, beneficial, social, or environmental impact. Of course, alongside with financial return, the idea is not to lose money, is to have a reasonable return on investment and move on to help other organizations. How big it is, again, it varies. But the figure we see out there, it's in the billions, 60 billions to be more precise, under management, 10 billion alone in 2014. And there are many graphs out there, many literature that you could search out and look at. There are books written on the subject. As I said, you have my email address here if you want to talk more about it. I have a slew of resources to share with you. But the most puzzling is that despite the fact that social investment and especially impact investing, it's alive and well out there, we have this erroneous understanding that it's not a good venue for investors, is not a good opportunity to have returns and yet help societies. Some say that the market is small, not scalable. Others say that the market rate has no quality or has a lot of risk associated with it, or is in the helm of charity and philanthropic organizations. All of that's true, but all of that also is not quite accurate. Yes, you have the philanthropy side of investing, and the idea here is not to make money, as I already mentioned, but in this 3 blocks in the center here, we find a very good comfort zone for impact investing. It's not mainstream, but it's focused on society, and it's focused on sustainable investing. It's focused on changing communities, changing societies out there. And there is a lot of money flowing into these industries. You see, for example, that the amount of investment nowadays is actually in the trillions, and a lot of packaged or areas of investment continue to proliferate. I itemize here a few areas that is finding way into impact investing, from public transportation infrastructure to fuel-free energy systems, secondary markets of development finance institutions, green real estate, including retrofits, agroforestry, and other social impact projects that, especially in my case, my experiences in Africa, in particular, so Lusophone African countries such as Angola and Mozambique. Curious enough, no fund is there. The opportunities are many. Of course, each investor has a certain tolerance for more or less risk. This is something that needs to be looked at. It's something that needs to be considered when investing. But there are trillions of dollars being invested out there with a high impact at societies and communities. The WRI, the World Resource Institute, has said that a lot of money is going into the transportation sector, for example. And you notice that the global vehicle fleet for that sector, it's expected to double by 2050. So there is a lot of opportunities out there to not only get a return on investment, but a significant return on investment. The opportunity is great for impact investing, but unfortunately, when you look at those interested in this kind of investment, and advisors that work with them, there is a gap. I think we are looking at one small plant and missing a massive forest of opportunities out there. You look at the women and millennials, they want to invest. And as I mentioned earlier, they want to invest with their values. But most advisors are lagging behind. And it's not me saying, I'm an academic, even though I do consult a lot on strategic and management consulting in these emerging frontier markets. You see here that when you look at the expectations and the interests of investors in sustainable investment, the interest is huge, especially among millennials and females. But when you look at the advisors' interest in sustainable investing, it's very low. So only a few are highly interested on this. You may be asking me this: what is the data and the date for this data? This is 2015, according to Cerulli Associates and the Morgan Stanley Institute for Sustainable Investing. So there is a gap that I think needs to be bridged. I think events like this and the one in Macau Thursday at the University of St. Joseph helps to begin the process. So we cannot forget that the way investing is being done these days need to change. How it works, it's very important because there's a lot of interest out there. Notice, for example, that in South Africa alone, there is a lot of money being invested. Lots of regions of Africa as well, 7 billion distributed throughout Africa. This is a significant movement. How does it work? It depends on the organization. I tend to recommend the processes that I mentioned here. Advisors and companies like Deloitte need to make sure that investors understand, and I'm sure they do, and create a process that allows for the identification of the opportunity, due diligence. This is all common even in traditional investment, the investment itself, and the act of ownership. It's something that's more prevalent when we talk about impact investing. And of course, an exit strategy. I'm not recommending it, but it's typical because you want to move on and impact other societies, other regions. How we do an identification, the project screening is important. Partner assessment is also very important, and of course at that point you might want to move to the next level, which is the due diligence, or abandon the opportunity. It's very important to understand the macroeconomics, the social cultural, the geopolitical aspects of that market, of that opportunity. The due diligence is very important, of course. There are different ways that we can impact these opportunities, these societies. Typical due diligence, well, I don't have to say in a forum like this, but we look at the quality and the execution strategy that we expect. That means that any investor should have a strategy that he or she feels comfortable with, and the organization that works with them should understand that strategy so that they can compare with the investment opportunity. I spent a month in Africa now in July, in Angola and Mozambique. I actually saw many opportunities. I interviewed 26 companies there, what I call micro M&Es, multinational enterprises. There were various opportunities, but various industries as well. It's important to look at the financial records of these companies, not only to look at the compliance with local government regulations, but also look into ethics and the way of doing business and the business model that they use. The project market demand and the competitions out there is also important. Is this a niche market? Is this something that the other investors can be involved with? The management team is important, especially when you invest abroad in what I call frontier markets. Alignment with the stakeholders and the shareholders is also very important, not only from the investment side, but from the companies that we are trying to help. Excuse me. Environmental and social risks is also important to take into consideration. Let's face it, when we talk about frontier markets, these markets are typically illiquid. There is a high risk of investment. They tend not to attract FDI, foreign direct investments. So there are a lot of reasons for them not to attract the type of investment, the traditional investment that will be more suitable for investors and companies looking for this kind of capital to continue their business. But there is an opportunity exactly because of that. Legal and corporate structures is also very important, especially working in emerging and frontier markets. Now, the investment stage, that's when you decide to invest. Agreements need to be in place, suitable to the policies and the strategies that you have in mind. The investment size and period. A lot of companies that I talk to and investors tend to invest for 5 to 10 years. and they have a set level of involvement, sometimes from 5 to 10 million. They don't like to be major investors. That means that looking the investment size and period is important, as well how funds will be disbursed, but who will be in that project with them, the structure that disbursement will have. It typically is a time-phased investment horizon, with tranches, for instance, linked to very specific milestones. And each market has different maturity. We need to look at that. We need to make sure that you're not coming in too premature, but by the same token that you're not being too conservative and missing the boat, so to speak. Active ownership, when we talk about the impact investing, is very important. What we find often is that the opportunities are many. I saw many opportunities in Mozambique, but the business owners, the entrepreneurs, they lack in many ways the skills to run the company, the political involvement of depth, macroeconomics knowledge, internationalization processes, knowledge, basic information about or knowledge about running their business. They have an understanding of the industry they are in, of the ownership that they have in their business, the uniqueness of the opportunity, but they need help. So impact investors tend, or at least should, be a lot more involved with the investments. Project management, for example, is key in this kind of investment approach, not only to support the teams in those countries or those regions, those opportunities, but also to make sure that the company invested are being provided with the resources necessary to continue to grow, to continue to strive to achieve maturity, to achieve sustainability, that they are operating in accordance with the strategy set from the get-go, from the beginning, during the due diligence. They are performing according to the financial plans set up. And mind you, a lot of that, setting up a business plan, determining business strategy, defining financial plans, will require the help of the investors and the companies investing in these ventures. Are they practicing satisfactory corporate governance and internal controls? Do they have reliable internal controls? Domestic laws. I mean, you will find that there's a lot of corruption in many of these countries. You will find there's a lot of evasion of taxes. You know, impact investors cannot be part of it. How do we know that these business processes are being followed? But also taking advantage of environmental and social concerns into account, that we're not violating. Instead, we're promoting it. The idea is to impact the region that they are working. And of course, at some point, there needs to be an exit strategy. At least that's what I tend to advise. Those of you here today may have a different approach to it, but the idea is to, once the company, the venture, it's sustainable, that they have achieved sustainability, that knowledge has been transferred to management, that there is a board that can continue to move on with the organization, then we will divest. We'll take our investment back. Normally what I've seen is 2 to 4, sometimes even 5% return on investment, and go help another region, go help another company. Of course, this is a little different than micro-lending, which can be considered impact investing, because you're giving capital to entrepreneurs that otherwise wouldn't have access to it. But in micro-lending, the return on investment tend to be higher, a lot higher, but risks also tend to be higher. So the idea is to find the time horizon that is adequate for the entrepreneur, for the business you're investing in, but also it's adequate for the capital that you're investing. After all, time is money, and it's not that we try to be greedy about that. That kind of investing is actually the opposite when we think about the impact investing, but we want to be able to help other organizations in similar situation. It all will depend on your strategy, and in your strategy, as you set the strategy, you should think about an exit strategy. It's very important also, I point here, to develop a post-exit analysis. Did you meet the strategic goals you have set? What worked? What didn't work? What were the lessons learned? That before reinvesting, because as you go into the next venture, you want to make sure to avoid the pitfalls, but you also want to make sure that you optimize the return on your investment, you optimize the projection of what I tend to call capability maturity of the organizations you are helping. I brought a short video here that I think is very important for us to take a look at if you have the time. This is an example of Norfund working in Ethiopia. It was very enlightening. Let's see it.
Ethiopia has long been considered one of the world's poorest nations. However, in the last decade, Ethiopia has seen impressive economic growth of between 8 to 10%. Small to medium-sized enterprises are crucial to Ethiopia's economic growth.
ICL is a diagnostic testing facility serving since 2004. It serves pretty much all the regions within the country. We serve close to about 600 patients a day.
Good business ideas need investment to grow. SMEs in emerging markets often suffer from insufficient access to financing.
There's absolutely no credit or financing available for healthcare institutions within Ethiopia. I did not have any access to grow the business and take it to the next step. And that's where Ascent Rift Valley Fund came into the picture.
Providing access to capital can empower businesses to overcome the obstacles to growth and deliver better services for consumers. Norfund, the Norwegian Development Finance Institution, aims to assist businesses like ICL, among others, through SME investment funds. In 2013, Norfund committed an investment of $10 million to Ascent.
Ascent Capital is a growth capital fund, so we look for investments in companies which have done very well in their own country and have the potential to expand regionally, much like ICL International Clinical Laboratories, which is our first investment here in Ethiopia.
We began our operation in 2004 with 30 employees and barely covering about 30 patients a day, to about 180 employees currently and about 600 patients a day. ICL became the first federally licensed institution that gave us permission basically to serve throughout the country. Patients don't have to travel to Addis, and we collect the samples, and we transport the samples to Addis, and using our own computer network, they get the results in a timely fashion. So we believe we've made a huge impact on a lot of patients' life throughout Ethiopia.
With the help of ICL, a lot of investigations that were to be done in Addis were minimized, and we can just send the investigations in Addis and get the results within 24 hours. And so we are able to diagnose and treat the patients based on the lab results we get from the ICL. We are helping a lot of poor people so that they are not expected to go a lot of distance and spend a lot of money.
Investment in promising SMEs leverages businesses to catalyze socio-economic growth. When implemented sustainably, such investment can also produce significant returns.
We hope to grow within the next year and a half to the neighboring countries, Kenya, Uganda, Tanzania, and South Sudan. And we'll continue to grow within Ethiopia, since that is one of our major objectives. We have a very good and close working relationship with Ascent. With their help, that we hope that we will be able to achieve what we really set out to achieve.
Well, I hope this was an opportunity for us to have a little glimpse on what investing with an impact is. Thank you very much.